In the world of corporate finance, there's this massive, high stakes game being played with debt. And guess what? The old rules, they just don't apply anymore. Companies are now using these really aggressive new tactics just to survive. So today, we're going to break down how this new game of liability management actually works. Okay, so let's get right into it. For years, for decades, the playbook for a company with debt coming due was super simple. You just refinanced it. You got a new loan to pay off the old one. Easy. But we are in a completely new era, and that old playbook, it's been tossed right out the window, replaced by something way more complex and way more aggressive. So you're probably asking, why the big shift? What's going on? Well, the economic pressures of 2026 have basically slammed the door shut on that easy money era. We're talking about higher interest rates that make new debt super expensive, inflation that just doesn't seem to want to go away, and banks that are holding onto their cash a lot tighter. The bottom line is that simple option to just refinance, for a lot of companies, it's just not on the table anymore. So this new reality, it demands a whole new strategy. And that brings us to the new debt playbook, which is built around these maneuvers known as liability management exercises, or as you'll hear them called, LMEs. This is how companies are now fighting to stay in the game. Okay, so what in the world is an LME? Put simply, it's an out-of-court deal where a company reworks its debt. But here's the kicker. It's all done by exploiting the flexibility, or, what some people would call loopholes, hidden deep in the fine print of those loan contracts. It's basically a way to change the rules of the game while it's still being played. And what's the end game here for a company using an LME? Look, it's not just about kicking the can down the road. It's a really strategic move. It's about easing the pressure of upcoming payments, managing their cash, and, this is the big one, reshaping their entire financial foundation so they can avoid a formal bankruptcy. At the end of the day, it's all about control. Now, these aren't just simple financial tools, not at all. These are aggressive, hardcore power plays. So let's crack open the LME toolbox and take a look at the three main strategies that companies are using right now. First up, we've got one of the most controversial and powerful moves in the entire playbook. It's called an uptier, and it's all about jumping the line. Here's how it goes down. A company basically picks a group of its favorite lenders and offers them a special, sweetheart deal. This group then provides a brand new loan that gets to jump to the very front of the repayment line, leapfrogging everyone else. And what about the lenders who weren't invited to this exclusive party? Well, they get shoved to the back of the bus. The key phrase here is non-pro rata. It's just a formal way of saying not everyone is treated equally. An up-tier literally creates a new pecking order overnight. Some lenders win big, while others can see the value of their investment just completely crater. Okay, so if jumping the line isn't an option, our second power play is just as crafty. It involves a bit of corporate sleight of hand, and it's called the dropdown. Seriously, think of this as a corporate magic trick. A company takes its most valuable assets, we're talking its crown jewels, and drops them down into a new, totally separate subsidiary. Then, that new entity goes out and borrows fresh money using those very assets as collateral. And the original lenders, they're left holding a claim on a company that just saw its best stuff vanish into thin air. All right, let's move on to our third play. This one is a bit more common, but don't let that fool you. It's still incredibly powerful. It's called the amend and extend, and it uses that classic carrot and stick approach. So here's the carrot and the stick. A company goes to its lenders and says, hey, give us more time to pay you back, and in return, we'll give you a better interest rate. That's the carrot. For those who agree, it's a pretty good deal. But for those who don't, well, they're the stick. They get left behind with the old terms while their overall position gets weaker. It creates this immense pressure to just fall in line and take the deal. So, after all these power plays are made, when the dust settles, what does the scoreboard actually look like? This is where we see the real consequences, the winners, the losers, and who is ultimately left in control of the situation. The single biggest result, the thing this all leads to, is a dynamic called creditor-on-creditor conflict. Seriously, forget about the company versus its lenders. This is now about lenders fighting each other, all scrambling for a better position in a deck that's just been completely reshuffled. An LME creates this huge divide. You're either an insider, you get priority, you get better terms, you get in on the new money, or you're an outsider. And the outsiders get pushed down, their claims get diluted, and they face a much, much lower chance of ever getting all their money back. The difference is just stark. So the crucial point is this. LMEs are all about reallocating control. The company gets to push back its deadlines and delay the financial pressure. The new friendly money comes in right at the top of the pyramid. And anyone who resisted or tried to hold out, their power gets systematically taken apart. Okay, so this is the new game. We've laid out the rules. So what's the key takeaway here? If you're an investor, or even if you're just trying to understand how the market works now, what are the red flags you absolutely need to be watching for? It all comes down to the fine print. I mean, everything. These aggressive moves are only possible because of documentation loopholes that let assets get moved around, consent rules that only require a simple majority to approve these massive changes, and of course, the ever-present risk of being left out of the good deal. And as you can probably guess, all of this leads to a ton of lawsuits. And if you remember one thing from this entire explainer, please let it be this quote right here. Control is not assumed by hierarchy. It is defined by documentation. That old idea that just because you're a senior lender, you're automatically safe, that's over. Today, the only thing that matters is what the contract says you can do. Which leaves us with one final and pretty critical question to think about. In a world where the rulebook can be completely rewritten mid-game by the people in charge, what is being first in line really worth anymore?